The markets today on June 13th were in absolute turmoil. We got the Dow down 2.79%, the S&P down 3.88%, and the Nasdaq pretty much leading the pack at 4.68%. Pretty much everything is in the red, and guys, I'm also invested in this market, and I'm here to show all of you guys my M1 portfolio. I am actually below my $100,000 mark. A couple months ago, guys, I actually put out a video saying my first $100,000 ever in my M1 portfolio. Well, I am no longer in that $100,000 club anymore. And seeing that there is a lot of fear in the market going on right now, even by CNN as well, showing that we are in extreme fear at 17 points on their gauge, I am here to offer you guys some white pills, or at least my version of some white pills, because there is a lot of people asking me what am I doing when it comes to this bear market, and Vivek actually commented in one of my videos saying any ballpark for market bottom, what will be the signs that you will look for, any video on when the Fed will stop raising interest rates. So I'm here to tell you guys off first that don't worry, this will get a whole lot worse, okay? The market has been overvalued, in my personal opinion, for, well, a really long time. Some people even say more than in 2020, but I personally think that in 2020 is when we saw one of the biggest bull market runs pretty much ever seen. In fact, you could even make out 2020 when the market bottomed just on a basic graph, right? Right here, we pretty much just did a complete V recovery, and then after that recovery, hitting the low as of what, March 19th, 2020, we just went on a complete bull run. And ever since then, guys, I've been pretty much saying that the market is pretty much overpriced. Because if you guys are following along, then you guys are probably noticing the majority of the companies I'm actually analyzing, I'm saying that they're pretty much overpriced. So the first thing I should probably tell you guys is don't worry, this is going to get a whole lot worse. I've been calling for an 80% on the market crash for several months now, actually, even since 2020, because honestly, companies are just way too much overvalued. Especially after 2020, we saw a massive hype when it comes to these companies that essentially didn't make any money. From the short squeeze that happened with GameStop all the way up to high home prices hitting new records month over month, guys, the market has just been completely overvalued since then. So I personally do not see this as a bad thing. If you guys are following my content, the one thing I'm always prefacing is make sure you have a process when you invest. That's why I do a fundamental analysis on all the companies. Because when you have a process, when you see the market fall and you have bought companies that you like, that you understand why you bought them, you guys seeing red, you guys seeing the Dow falling 2.79, the S&P 3.88, and the Nasdaq 4.68, this should absolutely make you ecstatic, because assuming that nothing has changed with the fundamentals of the company, their business model has not changed, you should 100% be buying more of the companies that you already like. The market is, for some reason, one of the things in the world that whenever things get cheaper, people run away. If you guys were going to buy a Lamborghini and it was worth 100 grand, and you go into the dealership and you say, oh, I like that Lamborghini, it's worth 100 grand, I'll come back tomorrow with the money. And then you come back tomorrow and that Lamborghini, same exact thing, same exact car, no difference, is now $50,000 instead of $100,000. Would you not buy it, or would you buy two of them? That's kind of my point. When the market falls, guys, when the market falls this much, I pretty much just take it as a huge buying opportunity. At least for me, I am absolutely loving this so much. It is getting me a chance to buy all these companies at a much cheaper price. And by the way, majority of the companies that I actually have ready to buy, they haven't even reached my level to actually buy them at. In fact, let me give you all an example. This is a video that I did on April 28th doing an analysis on Amazon. And in the video, I even go on to say that it is still very much expensive. The current share price when I did this video of Amazon, it was $2,763. And when I was doing my target share prices, well, they came up to be between 1,221 to 1,207, at least for the median assumption. Now, they recently did have a stock split. However, if we actually adjust for the stock split of 20 to 1, and we take the median assumption at $1,221 and bring it to after the stock split, the share price would actually be worth at around $61.05 for a target share price, not adjusting for debt. If we actually take a look at Amazon's current share price, guys, it is still $103.67. So where exactly does the market bottom? Well, I can't necessarily say that because unfortunately for me to do that, I would need to analyze all 500 companies in the S&P 500 and then take it as an average, which I'm just not going to do. But use Amazon essentially as a metric as to how much the market still needs to fall. And honestly, in my personal opinion, I would like it to fall a whole lot more because every single percent that the market falls, it is a buying opportunity. Again, for all of those of you who watch my content, you're probably watching it because you like the whole concept of investing through a fundamental basis. And when you invest with a process, you are not afraid when the market goes down. You actually love when the market goes down and hate it when the market goes up. Because when the market comes down, this gives you a chance to buy more and more companies. I get that right now, it seems like, oh my God, it just keeps going down. When will this end? You don't want it to end. Trust me, you want this thing to keep going lower. In fact, I'm going to give you guys a real life example that actually happened to me. And I'm kicking myself now because if I would have done it, I would be having so much money right now. It's not even funny. So let me actually show you guys exactly what I mean. On April 17th, crude oil futures reached a low of negative $37.63. One of my favorite companies, which is actually one of my biggest holdings in my portfolio, Chevron Corporation, at around the same time was worth around $59.39 because of the fact that oil futures went down this much. And looking at my Chevron position in M1, you can see that I have a massive cost basis at around $12,382. And you can see right here, my average share price is $101.24. Essentially showing you guys that I actually didn't buy it at the low. I actually ended up buying it at around like the $100 mark. As you can see, the current share price is $167 and I am up $8,798. In fact, at one point it was at around like $10,000. So if I were to have actually invested when the company actually fell to around that $59 mark with the same cost basis of $12,382, I would be up actually a huge amount, way more than $8,798. In fact, let's actually do the math real quick. If I would have put in the $12,382 at the lowest price of Chevron at $59, guys, that would have bought me around 209, essentially 210 shares, right? And after that, guys, Chevron skyrocketed all the way up to what, $180 or so. So if we actually continue doing this, taking the difference of 180 minus $59 and then times the number of shares that I actually bought with that, which was at around 210, guys, I would be up in Chevron alone, just in capital gains, not including the dividends, $25,000. Now, when this thing was happening, when Chevron was falling all the way down to 59 and oil was going down to negative, it seemed as if the world was ending, right? It seemed like it would never recover. And yet, look at this, guys. It absolutely did, and to the point that, well, it's up to $120 when it comes to crude oil. If I would have told you right here, at this bottom, at negative 37, oh, don't worry, in about 2 years, oil will go up to breaking all record highs at a whopping 120 and at some points even 121. You would have called me crazy. You would have been like, there's just no way. Well, the fact of the matter is that it did do that. Chevron did go up pretty much a lot. And if it wasn't for me being so scared to invest because of the fact that I thought that it wasn't going to recover, having the same fear, well, I only have $8,798 in the green as opposed to a whopping $25,000. Granted, again, this is not including dividends as well. And on top of that, this is not taking into account the fact that you probably would have bought all the way down and all the way up. So it would have averaged out at around the $59 mark. But nonetheless, guys, I would be up a whopping $25,000. So it just goes to show that just because the market is down, just because this looks scary, right? This looks scary doesn't mean that you should not invest. Every time the market takes a huge nosedive like this, especially when we have been overpriced for this long, now is a good time to buy. You do not want to buy when prices are going up because your $100 is buying less of a company than what it is now. One of my favorite companies, guys, AVGO Broadcom, is currently at $518.41 post-market. And at the bottom of the pandemic, guys, as of what, March 13th, around March 13th, 2020, it was $187. You're telling me that if this company fell back to around $187, $167, you wouldn't buy this company again, seeing the fact that it went from $187 to a high of $677, and on top of that, a massive dividend of $16.40 per year. You're telling me that you wouldn't do this? And that's just with this company. How about the one that everybody knows, Apple, right? The golden standard, the gold boy of the entire stock market. Apple, the first trillion-dollar company. You're telling me that if the company right now were to fall to its pandemic lows, which was around like $60 or so, you wouldn't buy it again, knowing the fact that it had a massive run up to a whopping $182.94, and on top of that, having a dividend of 92 cents per share? You're telling me that in hindsight, you wouldn't have done that? The thing is that unfortunately, looking back at it now in 2020, you'll be like, oh, I absolutely would have done that. Well, now that maybe you're actually might be getting a second shot, you guys should not be afraid of this. You guys should be loading up on all these corporations that you guys like, that have good fundamentals, assuming that, again, nothing has changed in the company. That's why, guys, when it comes to these calculators, I give them out for free because I want you guys to be able to analyze companies, and I want you guys to ask yourself a couple questions. Has this company changed now that the share price has gone down? Has the business model changed? Has their profits metrics changed, right? Has anything changed? If the answer is no and everything remains the same, then this is no reason as to why you should be afraid. In fact, the opposite. You should 100% be loading up. Warren Buffett is always saying a ton of quotes, two of which are applicable right now is that in the short term, stocks are a voting machine, and in the long term, they're a weighing machine. And on top of that, he also says one that people love to repeat, however, it is very, very difficult to actually apply, and that is the fact that be greedy when others are fearful and be fearful when others are greedy. Now, I showed you guys the fear index. Guys, there's a lot of fear in the market. Now is the time when you should be greedy. At least that's just my advice to you. If you guys want to use my calculators, guys, I 100% encourage you guys to do so. They're free. Use this one, use the book value one, use the REIT one, use a dividend tracking sheet, whatever it may be. But as long as you have a system as to and a process into investing, don't just invest because of hype. Don't just invest because stocks go up, right? If it goes up, it must be good. Not necessarily, right? In the 2000s, Amazon went from $116 to $6. While every other tech company completely went bankrupt because they didn't offer anything. We're seeing a lot of that now when it comes to companies like Palantir and all that stuff. In fact, even companies that aren't like Palantir that don't make any money, companies like, for example, Shopify, that have fallen down to $314 right now post-market and $313 essentially during the day, has fallen down from a whopping $1,762. And even though I actually put out a video saying that Shopify should be worth at around the $60 to $90 mark, somebody actually commented being like, no way it falls another 90%. And he pretty much went on to say, so you know where the bottom is. Wow, you are the first and only one. And I'm just like, I never said where the bottom was. I'm just saying this is what the company should be worth. And the fact that it fell from $1,700 to $300, I wonder what you were saying at around the $1,000 mark. So that just goes to show, guys, that you can 100% overpay for growth. Shopify is an example. Another one is, for example, Palantir. Palantir has fallen 69% on the 1 year and I believe 58% on the year to date. Currently worth $7.64 from a high of $29.29. So again, you can 100% overpay for growth. This is why I make my channel using a fundamental process in investing. None of this is financial advice. I will never tell anybody what to buy. However, what I am telling you is that you need to have confidence in the process that you follow. If you have a process, you will most likely succeed. And in the world of investing, all you really got to do is be 60% right of the time and you are considered a good investor. So when it comes to this turmoil, guys, I personally do not see this as a bad thing. I see this as a great buying opportunity. I hope that my portfolio, I get to see it one day at a negative $10,000 gain, like net overall, because that gives me the realization that all the companies that I loved, that nothing has changed, I can now buy at a cheap price, which is something that I really, really want. Now, in regards to the whole interest rates going up and all that stuff, well, guys, inflation rate is 8.6%. The Fed is pretty much just dragging their heels on this. If they really wanted to stop inflation, they would bring it up to more than 8.6%, and even that number is still fluffed. So when it comes to the interest rates, they're really dragging their heels. I do not foresee this stopping anytime soon. I think that we're going to reach 10% maybe by the end of the summer, maybe beginning of fall. That's what I think is going to happen. But unless the Fed actually brings up interest rates past the inflation rate, inflation will continue to go up. And if it continues to go up, the Fed will have to increase interest rates even more and more and more. So where the bottom is in the market, guys, I have no idea. Take this opportunity to buy companies. And in regards to the interest rates, I would not worry about what the Fed is doing, at least when it comes to stocks. Again, take this opportunity. If your stocks are red, do an analysis again. Make sure that nothing has changed. If nothing has changed, then you should keep buying more into ETFs like the S&P 500, VOO, Dow, NASDAQ, or into individual companies using a process. And if you guys want to use my discounted free cash flow and book value and recalculators, then you are 100% encouraged to do so by me. That pretty much does it for this video. Like if you like, comment, subscribe. It really does help here with the algorithm on YouTube. You guys can follow me on my YouTube sites, link in the description below, as well as a Let's Play channel. So with that said, peace out and keep investing.